Welcome back to Finora Finance, where we unmask the hidden mechanics of money, wealth psychology, and true economic independence. Today, we are diving deep into a phenomenon that is sweeping across modern consumer culture like wildfire. We're pulling back the curtain on the 10 unmistakable signs of the fake rich lifestyle. More importantly, we will analyze how you can protect your capital and avoid these devastating wealth traps. In an era dominated by hyper-curated social feeds, appearance has completely overtaken actual financial substance. Millions of individuals are actively sacrificing their long-term financial security just to look wealthy to complete strangers. This psychological trap is what behavioral economists call conspicuous consumption, a concept first introduced by Thorsten Veblen. Veblen observed that people use luxury goods to publicly signal social status, regardless of their actual net worth. But in the 21st century, this signaling has reached a dangerous, debt-fueled breaking point across the global economy. True wealth is completely silent, built on assets that compound quietly away from the public eye. The fake rich, however, must scream for attention because their identity is entirely wrapped up in external validation. Sign number 1 of the fake rich is a hyper-reliance on high-interest consumer debt to fund daily lifestyles. If you see someone driving a brand-new exotic vehicle but renting a small, outdated apartment, look closer. They're often leasing their reality, living paycheck to paycheck just to sustain a fragile, superficial illusion. They utilize credit cards, personal loans, and financing schemes to purchase depreciating assets that drop in value instantly. According to recent macroeconomic data, global household debt has surged to unprecedented levels, driven heavily by lifestyle inflation. People are borrowing against their future earnings just to look like they have already arrived at the finish line. This brings us directly to the concept of structural asset mismatch, where liabilities are disguised as genuine wealth. Robert Kiyosaki famously defined an asset as anything that puts money into your pocket on a regular basis. Conversely, a liability is anything that takes money out of your pocket through continuous, unyielding maintenance costs. The fake rich consistently mistake massive, cash-draining liabilities for wealth-generating assets, leading to a structural trap. Sign number 2 is the immediate compulsive display of luxury logos and brand names on every outfit. High net worth individuals, the quiet millionaires next door, often favor stealth wealth, focusing on utility, comfort, and longevity. They understand that wearing a massive logo makes them a walking advertisement for companies that profit from consumerism. The fake rich use these logos as a psychological shield to mask deep-seated financial insecurities and anxieties. They believe that a premium brand name automatically elevates their social standing and commands respect in public spaces. But true financial freedom means you no longer care about proving your worth to the outside world. Sign number 3 is a complete and total lack of emergency reserves or liquid capital structures. They may look like $1 million on paper or on camera, but a single emergency could destroy them. A sudden corporate layoff, a minor medical event, or a subtle market correction can completely shatter their facade. Nassim Taleb discusses the concept of fragility versus anti-fragility in economic systems and personal financial planning. The fake rich are inherently fragile because their entire lifestyle relies on the absolute perfection of current conditions. If their primary income stream dips even slightly, the house of cards collapses under its own immense weight. Wealthy minds prioritize liquidity, building robust cash runways that allow them to survive and thrive during downturns. Sign number 4 is an obsession with upgrading things that already work perfectly, driven by lifestyle creep. The moment they receive a salary raise or a minor business bonus, they instantly upgrade their entire life. They buy a newer car, move to a pricier neighborhood, and dine at increasingly expensive restaurants. This is known as the hedonic treadmill, a psychological cycle where satisfaction fades quickly after every new purchase. Because the satisfaction disappears, they must continually spend more money just to maintain the exact same level of happiness. As a result, their savings rate remains stuck at 0%, despite making a very high nominal income. Sign number 5 is talking endlessly about money, investments, and massive deals that never actually materialize. They frequently drop names, mention vague business partnerships, and boast about high-return projects to impress listeners. Real investors and business owners operate with extreme discretion, protecting their strategies and proprietary data. They know that executing a strategy in silence yields far greater results than bragging about unearned theoretical profits. The fake rich use financial jargon to sound sophisticated, yet they cannot explain basic macroeconomic principles. If you ask them to explain their net asset value or cash flow metrics, they quickly change the subject. They are completely infatuated with the romance of being wealthy, but completely terrified of the actual labor required. True financial literacy requires understanding how interest rates, inflation, and monetary policies affect your capital over decades. Let us examine the macroeconomic environment we are navigating right now to understand why this matters so much. Central bank policies, shifting inflation metrics, and changing labor markets are quietly punishing those who rely on debt. When credit conditions tighten and central banks raise interest rates, the illusions built by the fake rich shatter instantly. This macro shift exposes who actually owns their assets and who is merely renting an expensive lifestyle on borrowed time. This leads us directly to sign number 6 of the fake rich, a complete lack of high-yield, income-producing investments. While they happily display luxury goods worth tens of thousands, their brokerage accounts and investment portfolios are completely empty. They prioritize depreciating luxury items over compounding market index funds, real estate equities, or dividend-paying financial instruments. In the classic book, The Millionaire Next Door, Thomas Stanley reveals that true wealth builders maximize their allocative efficiency. They allocate a massive percentage of their income directly into appreciating assets before they even consider discretionary lifestyle spending. The fake rich do the exact opposite by treating investing as an afterthought, only doing it if money remains. Sign number 7 is an intense defensive hypersensitivity to any conversation regarding real financial metrics and long-term planning. When true wealth builders discuss financial matters, they talk about tax optimization strategies, cash-on-cash returns, and yield curves. The fake rich, however, become deeply uncomfortable, defensive, or dismissive when asked about specific asset allocation or net worth. They will pivot the conversation back to superficial material topics like luxury travel destinations or exclusive VIP club memberships. This defensive reaction stems from a psychological concept known as identity protective cognition, where individuals reject threatening financial facts. Deep down, they know their lifestyle is unsustainable, so they block out any analytical feedback that exposes their vulnerability. Sign number 8 is a consistent habit of treating service workers and retail staff with an arrogant, condescending attitude. They use these brief social interactions to project a false sense of absolute superiority and exaggerated economic power. True millionaires understand that financial abundance does not alter human value, treating everyone with quiet, genuine, and grounded respect. They feel no burning desire to prove their status to a server, a valet, or a retail store associate. This aggressive projection of superiority by the fake rich is actually a clear behavioral symptom of deep financial anxiety. They desperately need the immediate validation of others to convince themselves that their fabricated wealth identity is actually real. Sign number 9 is a toxic reliance on short-term trends, viral lifestyle aesthetics, and impulsive get-rich-quick schemes. They are constantly chasing volatile micro-assets, speculative meme tokens, or hyper-leveraged trading strategies without doing fundamental analysis. They lack the patience required for deep value investing, which Warren Buffett famously described as a slow, methodical process. Buffett noted that the stock market is a highly efficient mechanism for transferring wealth from the impatient to the patient. The fake rich want the massive reward today without building the boring foundational asset structures required to sustain it. They view the financial markets as a glamorous casino rather than a long-term venue for true capital compounding. This brings us directly to sign number 10. Their entire personal identity is completely dependent on their current spending level. If you strip away the luxury vehicle, the designer wardrobe, and the expensive outings, they experience an existential crisis. They do not know who they are without the material signals because they have never cultivated true internal value. Genuine financial independence grants you the ultimate luxury, the freedom to completely stop caring about the opinions of others. When you achieve true wealth, you realize that time, autonomy, and peace of mind are your most valuable assets. Let us pivot to analyzing the profound psychological differences between a wealth consumer and a strategic wealth builder. Consumers view money as a temporary tool to trade away immediately for instant gratification and fleeting social status. Builders view money as a powerful seed that must be planted, nurtured, and cross-pollinated into diverse income streams. This fundamental mental shift requires a high level of delayed gratification, which is the ultimate predictor of financial success. The famous Stanford Marshmallow experiment proved that individuals who master delayed gratification achieve significantly higher long-term life outcomes. In personal finance, delay in gratification means choosing to buy income-producing assets today so you can buy freedom forever. To escape the structural trap of looking rich, you must actively design a personalized capital allocation framework. This framework begins with automating your savings and investment contributions the moment your primary revenue hits your account. By paying yourself first, you remove the emotional temptation to spend your surplus capital on unnecessary luxury upgrades. You must treat your investment accounts like an unyielding corporate expense that must be settled every single month. The second step is mastering the art of lifestyle decoupling, where your spending habits remain completely flat as income rises. When your business scales or you receive a corporate promotion, resist the urge to upgrade your physical reality immediately. Instead, channel 100% of that new surplus revenue directly into your wealth-generating engine to accelerate compounding. This creates a massive protective financial buffer that separates your earning power from your baseline daily living expenses. The third step is developing a deep analytical understanding of asset classes, diversification mechanics, and risk management strategies. You should know exactly how your capital is distributed across broad market equities, real estate, and liquid cash reserves. True financial literacy empowers you to look at a luxury product and calculate its true opportunity cost over time. You stop seeing a $10,000 watch as just a watch and start seeing the 30 years of compounded growth lost. This analytical perspective transforms how you interact with consumer culture, making you completely immune to superficial status games. Welcome back to our ongoing analysis. Now that we have exposed the initial signs of artificial wealth, let us dissect the concept of wealth velocity. Wealth velocity measures how quickly your earned capital is transferred from a liquid state into long-term, high-yield, appreciating assets. The fake rich possess a high consumption velocity but an absolute zero wealth velocity, meaning their money exits their ecosystem instantly. Every dollar they earn passes through their hands like water through a sieve, immediately enriching retail corporations and luxury hospitality brands. To build an authentic financial legacy, you must reverse this cycle and maximize the retention velocity of your primary household capital. This brings us directly to sign number 6 of the fake rich lifestyle, the lack of true asset class diversification. When you examine their financial footprint, you find that their entire perceived net worth is tied up in a single vulnerable category. Typically, this category is their primary residence or an expensive, heavily financed personal vehicle that loses market value every single day. Ray Dalio, the brilliant founder of Bridgewater Associates, frequently emphasizes the profound importance of what he terms the holy grail of investing. Dalio demonstrates that holding 15 to 20 uncorrelated return streams can radically reduce your overall portfolio risk without lowering your returns. The fake rich ignore this fundamental principle because uncorrelated assets like treasury bonds or private equities cannot be flashed on social media. They refuse to invest in things that do not provide an immediate, loud visual payout to satisfy their social circle. Sign number 7 is a toxic relationship with the psychological phenomenon known as FOMO, or the intense fear of missing out. They are chronically anxious that someone else in their immediate social network is living a grander, more luxurious lifestyle than them. If a neighbor buys a premium boat or books a first-class vacation, they feel an overwhelming compulsion to match that exact expenditure. This creates an endless, exhausting game of keeping up with the Joneses, which is a guaranteed recipe for long-term financial ruin. True strategic wealth builders operate with absolute internal clarity, focusing entirely on their own personalized multi-decade financial benchmarks. They do not care if the rest of the world is splurging on temporary trends because their target is permanent autonomy. Sign number 8 is the continuous generation of non-deductible bad debt, which systematically erodes their disposable monthly cash flow. There is a monumental macroeconomic difference between strategic good debt and destructive consumer bad debt that everyone must understand. Good debt is leverage utilized at a low interest rate to acquire a cash-flowing asset, like commercial real estate property. Bad debt is high-interest leverage utilized to purchase a lifestyle item that does not generate a single penny of ongoing revenue. The fake rich stack bad debt upon bad debt, layering credit card balances on top of high-interest personal lifestyle loans. They find themselves trapped in a vicious loop where 40% of their monthly income goes solely towards servicing past interest. They are essentially working 40% of their days just to enrich the banking institutions that granted them credit lines. This massive debt drag prevents them from ever accumulating the necessary seed capital required to launch a real business or investment strategy. Sign number 9 of the fake rich is an absolute reliance on a single, fragile stream of active linear income to fund their entire existence. If they are a high-earning corporate executive or a specialized professional, they believe their massive salary makes them permanently wealthy. But a salary is a temporary stream that stops the exact microsecond you stop trading your limited physical time for a paycheck. True wealth is built on passive or leveraged income streams that flow continuously whether you are working, sleeping, or traveling. As the legendary investor Warren Buffett famously noted, if you don't find a way to make money while you sleep, you will work until you die. The fake rich are highly vulnerable to sudden economic disruptions because they have failed to cultivate alternative, uncorrelated cash flow engines. A subtle shift in industry automation, a sudden corporate downsizing, or a macroeconomic credit crunch can completely erase their lifestyle overnight. Sign number 10 of the fake rich is treating luxury items as an investment rather than a pure discretionary expense. They will buy an overpriced designer handbag or a luxury timepiece and try to convince themselves that it appreciates in value. While certain ultra-rare luxury goods do hold value, the vast majority of consumer luxury items depreciate rapidly the moment they leave the boutique. This is a classic form of mental gymnastics used to justify high-end consumerism to themselves and their concerned family members. True wealth managers look at expenses with brutal, unyielding honesty, categorizing luxury consumption exactly for what it is, an outflow. Now that we have identified all 10 signs, let us explore how you can transition into a true wealth builder. The transformation begins by shifting your mindset from a culture of high consumption to a culture of high capital production. You must begin to view every dollar not as a token to be spent, but as an economic worker under your direct command. Your job as the chief executive officer of your personal economy is to deploy those workers into highly efficient areas. Some workers will go into broad market index funds to capture the steady, compounding growth of the global corporate landscape. Other workers will be deployed into real estate equities to secure passive rental yields and powerful, long-term tax advantages. A portion must remain in highly liquid, high-yield cash reserves to act as a defensive shield during unexpected economic contractions. This structured capital allocation approach creates an unbreakable financial fortress that cannot be shaken by superficial social pressures. Let us look closely at a practical example of how a true wealth builder structures their primary capital deployment engine. Consider an individual earning $100,000 a year who chooses to live comfortably on $50,000. They take the remaining $50,000 and systematically distribute it across diversified, income-producing asset classes over 10 years. By maintaining this disciplined gap between income and expenses, they quietly build a multi-million-dollar engine while looking completely ordinary. Building this disciplined gap between your income and your consumption is the exact point where true wealth begins to take root. Let us contrast this with the psychological prison of the fake rich who live in constant terror of being exposed. Every single month, they must scramble to generate enough cash flow just to maintain the outward appearance of high status. This continuous pressure creates chronic elevated stress levels, which actively degrades their decision-making capabilities and long-term health metrics. Behavioral psychologists have discovered that financial scarcity, even when self-inflicted through overspending, significantly reduces an individual's cognitive bandwidth. When your brain is constantly calculating how to juggle credit card payments, you lose the ability to think creatively. You miss major business opportunities, overlook emerging market trends, and make impulsive, short-sighted choices out of sheer desperation. True wealth management, conversely, clears your mental dashboard, giving you the quiet clarity needed for innovative economic thinking. With a solid financial foundation, you can afford to calculate risks, invest in multi-year projects, and pivot during market disruptions. Let us look at the concept of asymmetrical risk, a favorite strategic tool of world-class investors and entrepreneurs. Asymmetrical risk refers to an investment opportunity where the potential upside vastly outweighs the defined, manageable downside. The fake rich consistently take on symmetrical or negative risk, risking large capital sums for tiny, temporary status gains. A strategic wealth builder searches for asymmetry, pouring capital into businesses, intellectual property, or undervalued market sectors. They know that one successful asymmetrical venture can completely transform their financial trajectory over the next several decades. To identify these opportunities, you must cultivate deep financial literacy and actively study global macroeconomic shifts. Look at how demographic changes, supply chain realignments, and technological innovations are currently reshaping the global corporate landscape. The individuals who position their capital ahead of these structural macroeconomic trends will capture massive generational wealth. Meanwhile, those trapped in the consumerism loop will continue to complain about inflation while funding the profits of major corporations. Remember, inflation is a silent tax that systematically transfers purchasing power away from consumers and directly to asset owners. If you only hold depreciating luxury consumer goods and cash, inflation will quietly erode your economic standing year after year. But if you own real estate, equities, and productive business infrastructure, your asset values naturally scale alongside inflationary pressures. This is why true financial education is not a luxury, it is an absolute matter of survival in the modern economy. Let us establish a concrete plan to systematically auditing your personal finances and eliminating all fake rich tendencies today. First, calculate your true net worth by subtracting your total liabilities from the current market value of your actual liquid assets. Be brutally honest during this audit. Exclude your leased vehicles, personal clothing items, and luxury accessories from the asset column. If the final number is negative or dangerously close to zero, accept reality without any emotional shame or self-judgment. This baseline number is simply your current financial coordinates. It does not define your future economic potential or self-worth. Second, immediately freeze all non-essential consumer spending and establish an automated debt repayment framework for high-interest accounts. Use the debt avalanche method, channeling your surplus capital toward the account with the highest interest rate first. This systematic approach minimizes the total interest paid over time, accelerating your path toward absolute debt freedom. Third, redirect your saved interest payments into building a fully funded 6-month emergency cash runway in a high-yield account. This liquid buffer is your financial armor, protecting you from having to take on new debt when life throws unexpected challenges. Fourth, once your defensive shield is established, initiate your wealth-building engine by setting up automated index fund contributions. Start small if necessary, but maintain absolute consistency. The habit of investing is far more important than the initial dollar amount. Over time, as your financial literacy grows, you can diversify into real estate syndications, private equity, or your own business ventures. Fifth, consciously practice the art of stealth wealth, finding deep personal satisfaction in your growing net worth rather than public display. Celebrate your financial milestones in complete silence, knowing that true freedom is the ultimate flex in a world filled with debt. You do not need the approval of strangers on social media when you have total control over your time and destiny. Imagine the sheer peace of mind that comes from knowing you can walk away from any toxic job or bad business partnership. Imagine being able to fund your children's education, support philanthropic causes, and build a lasting legacy for generations to come. This is the beautiful reality that awaits you when you choose substance over appearance and long-term freedom over instant gratification. The road to authentic wealth building requires patience, discipline, and a willingness to look completely ordinary to the untrained eye, but the destination is an unbreakable life of ultimate autonomy, deep security, and genuine personal fulfillment. As we conclude this intensive analysis, challenge yourself to identify one area where you can optimize your capital allocation today. Small, incremental adjustments made consistently over time yield compounding results that will completely rewrite your financial future. Stop playing the superficial status games designed to keep you broke and start building your quiet empire in silence. Thank you for investing your valuable time with us today on Finora Finance. Your financial future is worth every ounce of discipline. Make sure to like this video, subscribe to the channel, and share this deep dive with someone who needs to hear this truth. Leave a comment below sharing which of the 10 signs resonated with you the most, and let us discuss it as a community. Stay disciplined, stay analytical, keep compounding your knowledge, and we'll see you in our very next financial deep dive.